Hi everyone, welcome back for another crypto trade episode. In this video, I will show you how to set this quick and easy 5-minute scalping strategy that will allow you to invest your money and get high profits. This strategy works for crypto and Forex. I'm using 5-minute time frame on Ethereum USDT. Just watch this video until the end to learn how to use these great Tradingview indicators and thus get an extra income. Stay tuned to the channel by subscribing and activating notifications. You will be immediately notified every single time I post a new video. To add the first indicator to the chart, open the indicator search bar in Tradingview and type Stochastic. Select the indicator as shown in the video. Click on Settings and in Inputs tab, change second checkbox value from 14 to 5. Change third checkbox from 1 to 3. Click OK to finish. To add the second indicator to the chart, open the indicator search bar in Tradingview and type Ichimoku CLOUD. Select the indicator as shown in the video. Click on Settings and in Style tab, unselect all checkboxes except Conversion Line checkbox. Change its color to white and increase the thickness of the line. Click OK to finish. To add the third and last indicator to the chart, open the indicator search bar in Tradingview and type SSL HYBRID. Select the indicator as shown in the video. Click on Settings and in Style tab, unselect all checkboxes except Bar Color checkbox. Click OK to finish. Setup is complete. Don't forget to subscribe to the channel and activate notifications. As soon as I post a new video, you will be notified immediately. Thanks to these very smart indicators, you can follow the market trend and find high probability trade entries to maximize profits. The stochastic oscillator is used to show oversold and overbought conditions in the market. The idea behind using the stochastic is that price tends to close near the highs when the market is strong and near the lows when the market is weak. The stochastic oscillator is displayed as two lines, the K line in blue and the D line in orange. The blue line is faster and tracks the recent price action. The two lines will oscillate between a level of 0 and 100. The further away the lines are from 100, the more oversold the market is, and vice versa. If the blue line is above the orange line, this is a bullish signal. If the blue line is below the orange line, this is a bearish signal. I will use stochastic indicator to provide a market reversal signal. I will use Ichimoku CLOUD indicator to confirm if the market is bullish or bearish. I will use SSL HYBRID to show the entry point of the operation. Have you already smashed the like button? Doing that helps a lot in the growth of the channel. For a buy order, stochastic blue line must cross the orange line upwards. The lines can't be above the overbought area represented by the upper dotted line. The candle must close above the Ichimoku white line and it must be blue. If these conditions are met, place a buy order at the close of the blue candle. Place the stop loss below the nearest swing low. The risk to reward ratio will be set to 1 to 1.5. I hope you have understood the buying strategy. For a sell order, stochastic blue line must cross the orange line downwards. The lines can't be below the oversold area represented by the lower dotted line. The candle must close below the Ichimoku white line and it must be red. If these conditions are met, place a sell order at the close of the red candle. Place the stop loss above the nearest swing high. The risk to reward ratio will be set to 1 to 1.5. I hope you have understood the selling strategy. Traders who want to be consistently profitable know the importance of tracking the rights and wrongs of the trades that they take. Unfortunately, the impact of the trades that they don't take is too often overlooked. Traders are no strangers to missing good trade opportunities. At one point or another, we've encountered setups that we didn't take even though they so clearly fit our biases and strategies. Jeff could have been distracted by another trade while Peter lacked the confidence in pulling the trigger because his biases didn't match with his friends. Meanwhile, Violet has met her daily quota and has stopped trading while Michael simply didn't have enough balance for another trade. While there are good reasons for missing trade opportunities, not taking valid setups can also cost you in the long run. First, You're slowly damaging your account by not taking perfectly good setups. Missed trades can also make a dent on your trading psychology. If you make yourself believe that it's okay to not take trades after a losing streak, then you're falling into the recency bias trap. Losses are part of trading, and the results of your previous trade shouldn't influence your decision-making skills on your future trades. Last and probably the most dangerous impact of missed trades is its tendency to lead traders into taking revenge trades. It's hard to address a problem if you can't see it. For ways to minimize missed trades: journaling. Logging in your missed trades on a trading journal could help you identify your triggers and push you into sticking to your plan in the future. Set alerts and orders. If you don't have the time to watch your charts or you're not around when good opportunities usually pop up, then consider setting price alerts or using entry orders for your trades. You could even step it up by designing a simple mechanical system on your platform. Decrease your position sizes. If you miss most of your good trade ideas because you lack the confidence to take them, then you might want to decrease your position sizes. This way you'll lessen the pressure of trading for money. Of course, practicing good risk management techniques can also go a long way at boosting your confidence. Look at the big picture, except that losing is as much part of trading as winning. 1 or 2 losses won't matter if you trust your system and you look at the big picture. Getting used to losses is the only way that you'll be able to focus on the process instead of profits. Traders disregard missed trades simply because they don't see its impact. Unlike the losing trades that they do take, missed trades aren't usually logged in the spreadsheets with the goal of minimizing them. Unfortunately, you can't improve on what you can't see. I will now show some examples of buy and sell orders. Stochastic blue line crosses the orange line upwards. The lines aren't above the overbought area represented by the upper dotted line. The candle closes above the Ichimoku white line and it is blue. As these conditions are met, place a buy order at the close of the blue candle. Place the stop loss below the nearest swing low. The market has reached the target and the trade has been successfully closed. Let's look for the next trade. Stochastic blue line crosses the orange line downwards. The lines aren't below the oversold area represented by the lower dotted line. The candle closes below the Ichimoku white line and it is red. As these conditions are met, place a sell order at the close of the red candle. Place the stop loss above the nearest swing high. The risk to reward ratio will be set to 1 to 1.5. The market has reached the target and the trade has been closed with profit. As you can see, this strategy is quite simple to follow, but very profitable. If you are interested in having very positive results, use this proposed strategy. Test it and leave your opinion and results below in the comments. If you like the video, smash the like button, subscribe to the channel, and activate the notifications. This helps a lot in the growth of the channel. If you have any indicator or strategy that you want to see analyzed, leave your idea in the comments with the name of the indicators so I can study and analyze them. If it is interesting, I will produce a video with it. I will read all the suggestions you post. I hope you enjoyed the video and thank you for watching it until the end. See you next time.